I think multiple people use that term now that maybe this decade, oil is indeed the new data, if data was the new oil in the last decade. At the same time, I hear uh, enough number of people, Pinakin, talk about the conundrum that companies would be in that if, for example, if a Shell wants to lay out newer investments to expand capacities, it'll run into this whole ESG argument as well. So therefore, does this last for longer? Does it carry more investments, or would it largely be earnings led, which could come off as the commodity demand comes off? Is always that main argument. You must be facing this argument as well. How do you approach this when you are thinking through your construct?
Sure. So let's take a step back and let's look at energy in general and oil in particular. So the JP Morgan Global Energy team actually did a very, very good research report on the oil super cycle. This was done pre-COVID. Obviously, prices tanked. But the fundamental construct in oil has been that we have had a decade of underinvestment, and oil demand is going to continue to grow by at least 1 million barrels per year for the next 10 years or so. And you have production growth, which will struggle. And even on the ground, OPEC is struggling to bring in 400,000 barrels of oil per month that they have been talking about. So what you have is that barring massive investment in oil, capex, you are going to have deficits which are here to stay for the next few years or so. Our long-term oil price forecast is now at $80 a barrel. So what you have is that the commodity market is very delicately poised. You have, even with a steady state demand growth, supply which is not able to catch up. Equities, on the other hand, and this is not about Indian equities, if you look at global E&P equities, they are discounting an oil price of roughly $60 to $65 a barrel. So investors remain bearish on whether oil prices are sustainable. They worry about demand destruction. They worry about potential ESG issues. But what you have is, so far, we have not seen demand destruction. And even demand destruction would essentially balance oil markets temporarily, simply because of the supply deficits you have. And on ESG, what we are clearly seeing, and this is when we have spoken with so many investors, is that there is a dialing down of the ESG discount across the commodity space. Various macro factors have obviously helped, but investors are not as averse to owning commodity equities, oil equities today as they were 2 years back. So my sense is that, you could be in for higher for longer prices across commodities in general and oil in particular.
We know that the presumably the earnings momentum can be strong simply because of the higher APM gas prices and the higher average crude realizations, presumably. But production for Indian companies has always been a bit of a soft spot, at least to my understanding, and please correct me if I'm wrong. Do you reckon that as the year moves ahead and as higher earnings start to flow in, and I want to understand if you believe higher earnings will flow in, of course, but the hypothesis that they do you think the investor appetite for Indian upstream companies as well could meaningfully change from what it has been thus far? They've rallied a bit, but not quite in the same vein as maybe the metals did.
Sure. So, I mean, over here, we also, so first of all, stock performance, right? So this is the common complaint we get, that Indian upstream stocks have not rallied. Interestingly, if you were to pull up a screen of global E&P companies, the Indian ones have actually been among the top decile performers on a YTD basis, on a 1 year basis. What you have is globally E&P stocks have not done as well as global metal stocks have done. And this is for a variety of reasons, ESG issues, unsustainability of oil price, belief. So it is not that Indian E&P stocks have done very badly. Now, going forward, if you have regulatory certainty stay, and which is what our view is, that it should stay, we should have policy visibility and clarity, earnings will flow through. And for the Indian sector, right, higher earnings translates into higher dividends. Our sense is that the stock prices, even without a multiple re-rating, should at least track the equity consensus earnings changes, because consensus earnings across the board in India is pricing in far lower realizations and prices compared to where spot prices are. So as long as spot prices sustain at current levels, you should have stock prices track earnings upgrades, consensus earnings upgrades.
I presume that your earnings estimates, Pinakin, are higher and than what the street estimates are, because I've seen your reports. You've consistently been kind of more
Sure.
bullish.
So our earnings estimates across the commodity stocks we cover is higher than the street. Having said this, they also build in a big discount versus spot prices. So essentially, we see the cycle continue of the last 2 years, where the markets keep on getting surprised in terms of how sustainable these commodity prices are.
I would love to understand from you, how do you see the landscape evolving over the next 5 years with multiple other sources of energy being spoken about? I mean, while ethanol does what it does, green hydrogen right in the fray, and other factors coming into play. And is there a way? Are there many direct ways in which you can play it via the listed space, or would people necessarily need to go into indirect or unlisted place to do this?
At least, so when you look at the commodity basket, right? Most of the commodity companies are sticking to what they do, which is stay in the energy business, upstream business, and you do not have that many companies going and pouring into the non-fossil fuel energy businesses. So I guess as an investor, you would have to look beyond the commodity space in most parts, barring one or two names. And at least at this point of time, we do not come across as many listed names who are going in a big way in these non-fossil fuel energy sources.
This whole conversation about EU ban on Russian oil for the very near term, does it have a material impact, likely on sentiment and on oil prices, and thereby on the sentiment around the energy companies?
So it's a difficult question to answer. I mean, we would not comment anything directly on the conflict, but the JP Morgan Global Energy Strategy team, what they highlight is that we have a situation where liquidity is extremely low in the oil markets. And therefore, the market price movements on even a small dislocation in supply is very, very large. So a million barrels of energy supply can have a $35 price impact versus $15 to $20 what it used to be last year. So I think
Right.
we will oil should remain very strong in the near term.